Howdy, y'all. Welcome back. It's the weekly wrap-up for, what day is it? Friday, November 12, 2021. I hope everybody had a fantastic week. It's been beautiful here in Colorado. Still no snow. You know, the snow report's still out on that. But the weather's been beautiful. You know, days in the 50s and 60s, nights in the 20s and 30s. So, I mean, perfect weather for here. So I hope everyone out there in the interwebs had a wonderful week themselves. And all right, well, let's go ahead and jump into things. Let me share my screen with you fine folks. And where's my screen? All right. Where'd it go? Guess I'll just do that. All righty. So let's look at the market this week. Let me get rid of that and turn that off. And we'll look and see how things did. So this is the Dow Jones. Dow Jones this week was not ideal. So it looks like it was down about 0.87. You know, we did have a nice rally here today, but it's been ticking down the last couple of days. S&P 500. Let's see, that was down about 0.39. The NASDAQ. Looks like it was down about 0.9. The Dow Utilities looks fairly flat for the week, up 0.01. And the Dow Transports, I apologize for that popping up in the middle of the screen, was down 0.66. So it looks like most of the U.S. indexes were down for the week. So I'll be curious to see what the international space did when we do the weekly update next week. So let's go ahead and go back to what the chart looks like for the Dow Jones. All righty, let's go back to a daily chart, add back in my trend lines. So as you can see, beginning in August, about mid-August, we broke the trend. We broke this line of resistance right here. And we see that we had a bit of a downtrend for about 60 days. And about mid-October, it broke through the upside. So we'll see where this goes. You know, it looks like it's kind of stalling out here. If you can see that on your screens. So it's tough to tell right now which direction things are going to lead. You know, are we going to go back in the longer term path where we've been on, or is it going to resume this downward trend? So kind of a wait and see. I guess the next few weeks will give us some insight on what's going on there. So let's look at the economic numbers. U.S. jobless claims came in at 267,000. Forecast was 265, so pretty close. Last week's numbers were revised up from 269 to 271, still below the 275 forecast. Continuing jobless claims came in at 2.16 million. The forecast was 2.095 million. But again, let's look back at last week's. They were actually revised down about 4,000. But again, this number does continue to trend down. If you can see, prior to COVID, we had about 1.6, 1.7 was about the average continuing jobless claims on a weekly basis. So we have about 600,000 claims that we need to lose to get back to where we were prior to. So we're getting there. It's getting close. All righty. The U.S. JOLTs, it's a job opening and labor statistics. There are 10.438 million jobs out there. The forecast was 10.3. So slightly above forecast, and I drug this out as far back as we go. It takes us basically to around the year 2001. So you can see, back in 2007, jobless job openings were 4.5 million, and then as the financial crisis or the mortgage crisis occurred, jobless or job openings shrank, and it's been climbing. Fell again last year as things got so rough, and then has climbed up to an all-time high over the last 20 years. So, it's good that there's openings for people to get back to work. The problem is it doesn't appear that enough people are going back to those jobs. So we'll see what happens. I think people get hungry enough, they'll go back to work. The Consumer Price Index came out this week. Right now, the year over year is of the CPI is 6.2. The forecast had been 5.8. So, you can see that the inflation that we're experiencing is the highest that we've had since 1990. And then before that, the early 80s. So I was in like first and second grade back here. So I had no effect on what was going on back then. So, but we can see that, the inflation is spiking. Obviously we know why. When you print $5 trillion, it's going to have a negative effect on, prices around the marketplace. So we'll see what happens and how long this trend continues. So my personal belief is that until interest rates start climbing, which will be in July of next year, we're probably going to experience this until then. So I could be wrong. It's just my educated guess. So, all right. The core CPI, which excludes food and energy, is only 4.6%. So, if you're looking for the bright side, let's look. Okay. It's still not very good. And, again, you can see that, this peak is as high as it was back in 1990, 91. So I was in high school. I was a senior, or I guess I was a junior that year. So, I don't remember inflation being really that high. I mean, gas in Houston at the time was about $1 to fill up my 1979 T-Bird. That was a 25-gallon tank. So it ran me about $25 per fill up. Today, that would run me about $75. So, I'm not sure what the problem was at that point in time, but it's definitely as high as it's been in the last 20 years. So, all right. And the Baker Hughes rig count, we're up to 454 rigs online. Previously was 450. And if we go back here, we can see that over the last few months, we've gone from under 400 to the mid 400s. Still would like to see that number over 600. I think that would really help out with the price pressures at the pump. It's a slow process. I'm not in the oil and gas industry, so I have no say in this matter. But I have to imagine that the people who sell gas would like to get it out of the ground as fast as they can. All right. Had a couple articles I wanted to review before we end up the week. This first one comes from Mises Wire at Mises.org. First, this article is how asset price inflation is different from goods price inflation. This was written by Brendan Brown, and it was published on November 9th, which was my youngest son's birthday. And we were blessed enough to have him call us this afternoon. So that was nice. All right, let's dive in. There has been no constant concept of asset price inflation through the modern age of fiat money, even amongst those who recognize the condition. The term has become most popular in the present period of inflation targeting coupled with the use of radical monetary tools. The historian of economic thought could doubtless find some common threads through the evolving concept going back into the 19th century or earlier. Indeed, the first big example is the Dutch monetary inflation of the 1630s, featuring tulip mania, the bubble in stock of the Dutch East India Company and Amsterdam real estate. So if you don't know about the tulip bulb mania back in the 17th century, do a Google search, you probably find a YouTube video about it. It's pretty interesting. It really illustrates how a asset can, really get cause a asset bubble in tulip bulbs. Strangely enough, and eventually, when the bubble popped, all these people had these bulbs that were essentially worthless. So. All right, diving back in. How could Milton Friedman and Anna Schwartz have described the years 1922 through 1928 as the heyday of the Federal Reserve? Do everything right, apparently, whilst von Hayek in 2008, Rothbard in 2002, Robbins 2002, and many others viewed the same Federal Reserve during the same years as responsible for a huge credit boom and asset price inflation culminating in bust and Great Depression. So let's start this chapter with a modern definition. C. Brown, 2017. Asset price inflation describes the empowerment by monetary disorder of irrational forces in asset markets. This empowerment is characterized by an unusual prominence of certain flaws in mental processes as identified by psychologists. Examples include irrational behavior driven by mental pain of realizing loss, feedback loops from price action to assessment of relative speculative hypothesis, anchoring effects. These result from cognitive bias that describes the common human tendency to rely heavily on the first piece of information offered. Several others, including magical thinking, the attribution of causal relationships between actions and events which cannot be justified by reason or observation, and mental compartmentalization, an unconscious psychological defense mechanism used to avoid mental discomfort and anxiety caused by a person having conflicted emotions and beliefs within themselves. In pursuing the relationship between monetary disorder and asset price inflation, including an examination of mental flaws described, it becomes apparent that there are two types of asset inflations. The first is the boom type, which emerges under conditions of flourishing investment opportunities, and the second, a depression type, which forms when the overall economic situation is quite weak, albeit not so weak as to preclude the birth and growth of speculative narratives about investment opportunity, which in turn excite highly leveraged activity across a limited range of economic activity. These mental flaws are identifiable in various types of market conditions found under asset price inflation, whether characterized by the hunt for yield, characteristic of depression type asset price inflation, or irrational exuberance, characteristic of a boom type. There is much speculative storytelling, and many investors become abnormally ready to embrace these tales. Discarding their normal skepticism during the course of asset price inflation, the stories come and go as speculative excess produces outcomes, excess supplies, and falling profits, which discredit them. New information also provides contradictory evidence. The amount of distortion across markets is not general or equal, but depends on the evolving speculative narratives and the catalysts which drive these. The most powerful narrative of all the new magical instruments designed by the central bank, and more generally, the success of the monetary experiment. There are also narratives about the wonders of financial innovations, whether new products or new forms of asset management, buttressed by the wonders of leverage and momentum. Stages of asset price inflation. The asset price inflation goes through different stages from start to finish. Early on, currency devaluation may play a lead role in generating speculative stories. In practice, the Federal Reserve, as the dominant central bank, is in front here. Even though other central banks at this early stage may not have launched their own contribution to the global monetary disorder, asset markets in their countries or currency, even if floating freely, can become subject to the forces of irrationality stemming from the United States. In the mid-phase, forces of irrationality have strengthened, and these spread over a wider span of asset markets, giving rise to what market analysts describe as speculative froth. Yet in some markets, the froth is already receding amidst the din of apparently isolated crashes. The central bank may respond to these out of concern that the sudden drain of speculative froth across all markets could occur by undertaking further monetary reflation. If successful, this might even introduce some bottom fishing in the crash market, whilst adding to heat elsewhere. In the final phase, there is almost the general plunge into speculative temperatures, sometimes financial crisis and recession. The full extent of malinvestment at last becomes apparent. The waxing and waning of speculative stories are central to the process of asset price inflation. Through time, the revelation of malinvestment, most likely via plunging profits or rents, and growing expectations of tightening in monetary conditions, coupled perhaps with actual tightening, are catalysts to the waning. In particular, as the appearance of speculative froth grows in intensity and alongside forecasts of rising goods and services, inflation gains prominence. Speculation grows on normalization and tightening of monetary policy. In principle, we could imagine an asset price inflation coming to an end through a process of speculative stories waning amidst accumulating disappointment, including the identification of malinvestment without any normalization of monetary policy. In the small sample size of history, though, there is no unambiguous practical example of this. The asset price inflation of 1934 through 1937, in some respects, is the closest, though there is a popular historical folklore which blames the crash and recession of 1937 through 1938 squarely on the Fed's error trying to normalize monetary conditions too soon, even though short-term interest rates hardly increased. See Brown 2016. It is possible, in principle, for an asset price inflation to come at the end without the arrival of the deadly late phase asset crash and recession, with the emergence of an economic miracle which justifies values previously based on much speculative froth. So that's, kind of goes into the nuts and bolts of what causes inflation from the very beginning through the very end. And, ultimately what, will probably lead us to is some sort of a recession or depression over the next decade. All right. And then this next one, also from Mises Wire, is price inflation hits a 31-year high as Janet Yellen insists it's no big deal. This was written by Ryan McMacken this was published on November 10th, which was Wednesday. The Bureau of Labor Statistics reported Wednesday morning that prices rose 6.2% on a year-over-year basis in October. That's the highest year-over-year rate since December of 1990, when Consumer Price Index was also up 6.2%. October's rate was up from 5.3% in September and remains part of a surge in the index since February of 2021, when year-over-year growth was still muted at 1.6%. Not surprisingly, producer prices surged in October as well. The producer price index for commodities in October was up 22.2% year over year, reaching a 48-year high. We must go back to November 1974 to find a higher producer price index increase at 23.4%. And I was born in February of that year, so I would have been 9 months old. So, wow. Asset price inflation has naturally continued unabated as well, with the result being rising housing costs. In addition to the consumer price index's 31-year high, home prices in the second quarter surged to near a 42-year high, according to the Federal Housing Finance Agency's home price index. Home price growth reached 11.9% in the second quarter of this year. Since 1979, only the second quarter of 2005, also with 11.9% growth, showed home price growth as high. This is troubling information indeed, given the average real weekly earnings that have turned negative this year, with inflation-adjusted earnings down 0.5% from September to October. It is increasingly clear that wages are not keeping up with rising prices for a great many Americans. Yeah, I'm one of them. So none of this means policymakers will diagnose the problem properly. However, we should expect discussions around inflation in Washington to keep missing the point and denying any connection to the central bank or monetary inflation. For example, rising prices are so obvious now that not even the administration can ignore them anymore. Today, the White House released a statement in which Joe Biden admitted, "Today's report shows an increase over last month. Inflation hurts Americans' pocketbooks." Well, no crap, Joe. I guess they woke him up long enough to say that. Yes, the administration continues to be very much in denial about the cause of price inflation. The Biden statement continues, "I have directed my National Economic Council to pursue means to try to further reduce these costs and have asked the Federal Trade Commission to strike back at any market manipulation or price gouging in this sector." That is funny. He's going to have the FTC strike back at market manipulation. Well, what's the Fed been doing for the last 2 years? I mean, printing all that money seems to be market manipulation in my point of view. But hey, what do I know? If price gouging were the cause of nationwide price inflation, if it were gouging, we'd be seeing increases only in areas where so-called gouging is taking place. Moreover, that would mean a decline in spending and thus price deflation in areas where the gouging isn't taking place. The overall effect would be price stability. Well, that's not what's happening. Similarly, the administration has also tried to blame blame inflation on lack of childcare. Okay, in an incoherent series of non sequiturs, Secretary of Transportation Mayor Pete this week claimed that paid family leave is part of the administration's toolkit to fight inflation. Buttigieg simultaneously claimed that paid family leave means more people can take time off from work, yet somehow this will also translate into more people getting back to work. Yeah, people. And I have a question about that paid family leave. Who pays for that? I know if I was hiring people, I wouldn't want to hire anyone who needed paid family leave. So, I know that's probably not cool with the equal employment or whatever BS. But I'm a sole proprietor. I'm not hiring anybody, so it's fine. All right, where was I? While it's true more workers could help temper to some extent upward pressures on prices, more paid family leave would contribute nothing to the solution to price inflation. Rather, it's apparent the memo went out to the administration that every policy must now be tied to some plan to fight inflation, no matter how tenuous the connection. All right, so there's a lot more to this. I'm gonna go ahead and stop there. But as you can see, those in charge keep saying that we're not in an inflationary environment, and it's pretty clear we are. Fuel prices are up. I know earlier in the summer and in the spring, I was defending the current administration when people were bitching and moaning about fuel prices, the price of gas, in May of last year versus May of this year. It wasn't really a fair comparison because the price of fuel had dropped precipitously because of the shutdown last spring and summer. So, but if you want to compare prices from, say, 2 years ago at this time to now, that's a completely fair comparison. And, I certainly welcome that. But, I don't think that, this inflation is, or all these, fire extinguishers that they're using to try and put out inflation is really going to do anything long term, again, until interest rates are risen. So, all right. Well, that's everything I had for today. I rambled for a good 21 minutes. Damn it, I did not mean to take that long. Be sure to, if you could, like, subscribe, share this with friends and family. I would greatly appreciate it. I'm sure there's folks out there who are confused at what's going on in the world and maybe just need some plain English to break things down and put it into simple terms as far as what the real picture is. So feel free to share this with anyone who you think might get some value out of it. If you need anything from me, feel free to shoot me an email, give me a phone call, send some smoke signals if you feel that's appropriate. And I hope everyone has a fantastic weekend. I will be back on Monday with the weekly update. And let's hope for some better times. I know the Rittenhouse trial's coming to a conclusion, and some of the rumblings I'm hearing down in the grapevine that there's going to be some more violence. I certainly hope not. Violence, that tearing up people's neighborhoods and streets is not the way to solve problems, because it's only going to lead to, more strife and more of the left and the right hating each other. So, anyways, all right. Well, again, everyone have a great weekend. I'll be back on Monday and I'll talk to you later. Bye.